Welcome to the Riskwiser Zone. I'm your host, Lewis. Today, we're going to dive into the world of home equity lines of credit, or HELOCs, and explore whether they're a good idea for homeowners looking to tap into their equity. With interest rates at historic lows, many are considering using a HELOC to fund home improvements, consolidate debt, or cover unexpected expenses. But before we jump in, let's take a look at the current state of the market. According to recent data, the national average for a HELOC is 7.20%, while home equity loans are averaging 7.47%. These rates can vary significantly from one lender to another, so it's essential to shop around and compare offers. Some lenders, like Four Leaf Credit Union, are offering introductory rates as low as 5.99% for 12 months on lines up to $500,000. Now, you may be wondering if a HELOC is right for you. The answer depends on your individual financial situation and goals. If you have a low primary mortgage rate and significant equity in your home, a HELOC could be a good option. However, it's crucial to understand the terms and conditions of the loan, including any fees, minimum draw requirements, and repayment terms. We'll also explore the pros and cons of fixed-rate HELOCs, which can provide more stability and predictability for borrowers, and we'll discuss how the current housing market could impact your decision to take out a HELOC. As we navigate the world of home equity lending, it's essential to remain informed and cautious. We'll examine the best HELOC lenders of 2026, including those that offer flexible payment options, high CLTV ratios, and competitive rates. Whether you're a seasoned homeowner or a first-time buyer, understanding the ins and outs of HELOCs is critical to making an informed decision. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the latest economic news from around the world. Today, we're focusing on the impact of the West Asia conflict on India's economy. Now, I know some of our listeners might be thinking, Lewis, how does a conflict in West Asia affect India? Well, let me tell you, it's all about the oil prices and commodity prices. According to a report by CRISIL Intelligence, if the conflict in West Asia is prolonged, it could pose a downside risk to India's economic outlook. The report expects India's real GDP growth to moderate to 7.1% in FY27, which is still a healthy growth rate, but slightly above potential. Now, this growth will be supported by robust private consumption and a mild pickup in private investment. But here's the thing. Retail inflation is likely to rise to 4.3% on average in FY27 from an estimated 2.5% in FY26. And that's because food prices are expected to remain benign, assuming a normal monsoon in 2026. So, inflation should normalize from its current lows. Now, I know some of our listeners might be thinking, what about the RBI? What will they do? Well, according to CRISIL, policy rates will likely remain steady in FY27, and the cumulative rate cut of 125 bps undertaken in calendar year 2025 will continue to be transmitted to bank lending and deposit rates. But let's not forget about the oil prices. Rising oil prices and the risk of widening deficit have also accelerated foreign portfolio outflows from India. So far this calendar, foreign funds have pulled out 35,808 rupees crore from Indian markets, reflecting in the weakness of the rupee, which plunged to an all-time low of 92 rupees and 35 paise per dollar on Monday. So, what does it all mean? Well, it means that while India's economy is still growing, there are risks on the horizon, and, as investors, we need to be aware of these risks and adjust our strategies accordingly. Now, let's take a look at another report from Economic Times, which says that the West Asia conflict poses a downside risk to India's economic outlook. The report also mentions that private investment sentiment is improving with a recovery in private capex underway, driven by emerging sectors. So it's not all doom and gloom. There are still opportunities for growth, but we need to be cautious and keep an eye on the global events that can impact our economy. Welcome back to the Riskwiser Zone. As we wrap up today's show, we're going to dive into a complex and evolving story that has significant implications for global markets and economies. The conflict between Iran and its neighbors, as well as the United States and Israel, continues to escalate, with attacks on shipping vessels, oil facilities, and other targets. According to recent reports, Iran has launched multiple salvos of missiles at Israel and Gulf Arab nations, prompting warnings from the Israeli government of potential Iranian attacks. Meanwhile, Saudi Arabia claims to have destroyed 6 ballistic missiles launched towards a major U.S. and Saudi-operated airbase. The situation is further complicated by the fact that the Strait of Hormuz, a critical waterway for international oil trade, has been targeted in these attacks. The U.S. military says it has destroyed 16 Iranian mine layers near the strait, but there are concerns that Iran may still be attempting to mine the passage. Oil prices have remained high due to fears of prolonged shipping disruptions, with Brent crude up around 20% since the start of the conflict. In response, countries like Germany, Austria, and Japan are releasing parts of their oil reserves to help stabilize energy markets. It's essential to note that the situation on the ground is fluid and rapidly changing. We've seen reports of casualties and damage in Lebanon, Iran, and other affected areas. The international community is urging restraint and calling for an immediate end to hostilities. As investors, it's crucial to stay informed about these developments and their potential impact on global markets. While it's impossible to predict the outcome of this conflict, we can expect continued volatility in oil prices and potential ripple effects across various asset classes. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.